What's up, YouTube? It's Joe Catapaglia sitting on the couch, making some money investing in fractional real estate online, as usual. Today, I'm going to give you a good example of what keeps bringing me back to Lofty. I know I spend a lot of time complaining about them. I think that the marketplace has leaves a lot to be desired, but there are just continually opportunities if you're paying attention. I'm going to show you one today. It's kind of interesting. It's a 999 Canyon Road in Ogden, Utah. This is a property that one of my very early videos, I did it in September of last year. It was very new to Lofty at the time. I'm going to put a link to that video in the description to this one if you want to go back and look at it. At the time, the property was a short-term rental. They have since converted it to long-term rental. At the time, tokens were $50. Now they're under $36. Actually, when I click through and try to buy it, ends up bringing it right up to about $36. And this is so at the time, I identified several issues with it as a short-term rental that I thought could potentially lead to problems. The biggest one being that they just had a terrible revenue to price ratio, compared to what I'm used to looking at. And since then, it dropped off. They did even worse than they had been doing. And because it was already a low revenue to price ratio to begin with, um, they just weren't able to cover their even the expenses of the property with that, with the revenue that they were making. So they, to his credit, the co-owner came to the platform and said, "Hey, let's do a vote. Let's turn this to a long-term rental. At least then we'll create some yield. We won't be losing money." Now, one of the things that I had brought up when this first came on the market was, well, this is two units. It's two individually owned units, but they're built as a duplex. But so it's basically you're getting a condo that of one half or the other. I think it's actually set up as a condo, but you're getting one half or the other of the property. The other half, the owner was also running as a short-term rental, and he has since listed it on Lofty, but didn't sell any tokens, at least as far as I know. Um, I guess I could check that, but that's something you might want to do that for some due diligence. But so one of my concerns was, well, when he was selling this one but not the other one initially, if you're running them both as a short-term rental, you're going to have an incentive to send more of the guests to the other side, right, to the side that you own free and clear. Um, not that I'm saying that that's what he's done, but that was one of the risks I wasn't really comfortable with if I'm owning two side by side, that are basically you could have somebody try to stay in one and you can move them to the other one. Um, it's somewhat problematic if I only own one, right? And so they don't have that incentive. So I am curious if he's had to switch the other side to long-term rental too, or if by getting rid of this competitor to his other one, if it's actually going to do better. I have no idea. So that'd be something that would be worth looking into if you really wanted to move forward on this deal. But so, one of the things I've mentioned lots of times is almost all the times when I've made money on Lofty, it's because somebody else has lost money. Well, that's going to be the case here too if I buy these, right? Because people were buying these at $50, uh, you know, less than a year ago, and now we're at $36. People have lost. I don't know what is that. It's under like 28%, something like that. 26. It's too late for me to be doing math in my head. So if it's 36, so 14, 28%, losing 28% roughly of their value. Um, if you go back and watch that video, these returns were, projected return of 20% and, 19% yield, something like that. And I just, at the time I questioned, I was like, is this even possible? I don't think so. Um, so unfortunately, people made the decision to buy. It didn't work out very well. Things changed. It didn't, what it had to do is really overperform, and it underperformed. Um, but so, like I said, to his credit, he went and was proactive and he proposed a vote to switch it to long-term rental. That's the plan. So I wanted to look at this at this price as a long-term rental and to see, okay, what does it look like from that perspective? So first of all, if we look at the appraised value, it's 505. Um, it was hard to find comps early on, and the same thing. I did find this one. where this is a close, where it has a higher price, but it thinks it's a single family home. So, I think out of everything I could find, I think the 505 seems like a reasonable price for the half that we're buying. There is debt on both sides. There's separate loans. I actually went through into the drop boxes just to make sure that it wasn't one loan across both, but it looks like they are separate loans. There's statements with two different addresses on them. So owes about 270,000, which leaves 235,000 in equity. And so I'm ignoring their financials tab. And more you're seeing me do this, right? Because I don't care what, their numbers are just not, they're not really conducive to figuring out, is this a deal for me or not. So I'm just ignoring this, right? Uh, I'm looking at the actual appraised value, 505. There was some furniture involved, but that's going to be sold. He did say whatever he sells it for, he's going to distribute some of those funds. I wouldn't count on that being very much money whatsoever. But if that happens, that's great. So okay, you have about $235,000 in equity. Divide that by the outstanding tokens, and when I look at the order book, 5,371. So that leaves us, equity per token of $43.75. Right now, the market price is 36 bucks a token. With fees, that's 39.06. If you buy them on the marketplace. Now, this doesn't take into account slippage. I think if you started to buy a whole bunch of this, it would go up. But if you just, started nibbling at the $36, your discount from the appraised value, right, is $4 per token, and that is a better discount on than than what we're finding. And that's the discount from the equity amount. That's $43. This isn't. You notice I'm completely ignoring $50, right? $50 isn't coming into play at all. I don't care that that's what that initial token was worth. I'm trying to figure out, okay, what's this actual, what is this token worth? When I look at the equity relative to the debt. And now again, it doesn't mean if we sold today we'd net 43.75, because with closing costs we'd end up doing significantly worse, right? But that's always going to be the case. If you buy real estate today, sell it tomorrow, you're going to lose money. So in any case, being able to step into this at with $4, in profit essentially, um, is in equity. You're basically spending 39 to get something that's worth 43.75, just from an appraised value perspective. Now we also have to think about, well, does this actually work as a long-term rental? Sorry about that. I have 83 tabs open and my screen recorder hates that. So I closed a few. Hopefully we won't have that again. I know I've been complaining about it for almost a year now, and I just haven't fixed it because, this channel, as much as I am committed to doing it every day and trying to build our community here, it is still pretty much a hobby. So sometimes if I have to drop the ball on something, it's not my day job, it's this. So sorry about that. Digging into, does this work as a rental though, right? I mean, that's the next step to figure out. The co-owner had mentioned 220 or 2250 as a rental rate. I checked, a Zillow rent estimate. It gives us a similar number. So I just use that as an estimate. One of the things, I've waited this long to buy this. Maybe I'll just wait until it's actually rented to go ahead and buy more tokens. I don't really think the price is going to go up very much when that happens. When we get into the yield, I'll explain why. But so, okay, then I'm applying a 5% vacancy collection loss. Um, I don't have, I didn't do any market research to figure out, is 5% really the right number in this market? I always just like to have at least some minimum. That's what I did. You're going to see, like, I try to make this as conservative as possible. But really just, again, not doing, just doing some guerrilla math, right? Like not really diving into the weeds. Before I buy this, if I want to, I'm either going to need a bigger discount, or, once I show you the numbers, or I'm going to, dig in and really figure out, is this vacancy collection loss make sense? Now, if I buy, it is a large property. It's a 4 bedroom, 2 bath. It's a nice property. It's a pretty decent rental rate. If I wait until it's rented out and I feel like they did a good job screening that tenant, I feel like 5% is probably a good number to cover me if depending on how that tenant search goes and whatnot, maybe not, right? And that'll give us more info. I think that'll be really seeing like how many potential renters show up, what that process looks like will tell us more about what the vacancy is going to look like than anything else. How long it takes it to rent initially, and I can wait until that happens before I have to buy, right? And so that's one of the things again why it's really nice. I don't have to really guess. I can wait and see. So okay, then I had my net rent, charge the 10% management fee on the net rent, and that is something that changed. This had been a 25% management fee, and he actually said he's going to move it down to. It was in the vote that went out that it would get moved down to 10% after the first 3 months. Um, yeah, 3 months after the proposed change. So, the initial yield will be a little bit lower because it'll stay at the 25% until after that. Um, for taxes and insurance, I just pulled the amount that's being escrowed on the mortgage statement. So, typically that's going to be a pretty good number to figure out what we're paying in taxes and insurance. I again just picked a 5% repair and maintenance estimate. It is a 2018 build, so I'd expect it to be in relatively good shape. Although, 7 years in, probably time to replace a hot water heater, or, a lot of times they don't last much longer than that, depending on if you have hard water or not in your area. Um, but, you expect to have quite a while still on the roof and the structure and, uh, even the HVAC, I'd expect to get 5 years plus out of it. But again, one, we can go back through and look at the inspection that we looked at originally. That might give us a little bit more of an indication. But again, just for rough math, just picked 5%. Use the 750 yearly lofty fee, and so then our total expenses, $880 a month. NOI about 1250. Annualize that and looked at what that is per token. It's $2.81. I did do a yield at 50 because I was trying to match it up with what people were saying in the Discord about what the yield was, and they were all just calculating it based on 50. I'm sure most of the people in the Discord paid 50, and so that's what they care about their yield on. Uh, but that's, for me, looking at this property today, if I wanted to look at it at 36, it's a 7.8% yield. But really, if I wanted to look at it at the total cost, the 36 plus fees, 7.2%. Now, you can't just go on Lofty and compare the 7.2 to the ridiculous 20% yields that they're showing, because if you remember, this one showed 20 or 19% yield in my last video of it, back in September, and it's just not a real yield, right? Like, it might have been real for 1 month and they annualize that 1 month, or maybe even a couple of months. But this is, I think, a realistic, you know, putting some actual assumptions as far as vacancy, as far as repairs and maintenance, not just picking a perfect month and annualizing it. So, you know, for a 7% cash on cash return on a deal that I'm doing absolutely nothing, and that I'm buying at, getting a 10%, boost to my equity instantly, this starts to look like a really interesting deal to me, right? And I think that I am going to wait. One, I think with the yield continuing to stay low, there's a chance that the prices of tokens will come down even further. Um, but in addition to that, I think that there's not a whole lot of risk in me waiting to see what happens as far as it actually getting leased up, because even once they lease it up, this yield is going to show, their yield is going to show, it'll show a higher number than this, I think, but it won't be a great number. Um, and so because of that, in the way that the typical lofty investor is, pricing tokens is primarily based on yield. Uh, I think we'll be able to do pretty well, right? Like, I think, it should probably still stay around this price, and if it doesn't, well, I missed it, and it's not that big of a deal. Uh, I know I say, I want you to make sure that you are doing your own due diligence. Before I forget, please like and subscribe. In the description to this video, I have links to all the places where I'm currently investing in fractional real estate online. on all of those platforms. Do your own due diligence on the platform itself and on any properties that you see me talk about on there. Just like this one, I mean, I tell you a lot of things that I think is wrong about Lofty. And I've definitely in this video and the last one, shared some concerns I have with this property. But you want to do all your own due diligence. Don't just take my word for any of this. Do your own math. Also, don't just let AI do your math. I have noticed, I've been talking about this a few times lately. There's definitely people that are screwing stuff up by doing that. Now, obviously, you can make mistakes doing it by hand as well or doing it by Excel, but at least in that case, you can go back and see where those mistakes came from, right? So you can audit yourself a little bit easier than you can if you're just like outsourcing all the thinking. Um, I know it makes me sound like an old person when I complain about, people using AI, but I actually use it quite a bit, but it's not something that I would ever replace my underwriting with, right? Like I really want to be able to see exactly what's going on, calculate the yields myself, figure out what's actually going into my calculations, and know what's being left out. Um, Oh, also in the link, in the description of this video, there's a link to an invite to our Discord. It's just the fractional real estate investors general Discord. We talk about all the different platforms. If you want to jump in there and argue with me about whether or not you should be using AI for this, that would be fun too. Because like I said, I mean, I definitely have an old guy perspective on it. What is funny is, when I first got my job, one of the places, got into commercial real estate, one of the places that I got a job offer from actually made me do a handwritten discounted cash flow analysis on a property and then gave me an Excel test as well. But they really thought you need to be able to do all this math by hand. Luckily, I had just come out of grad school and paid attention to the actual math of it and was able to do it. But me expecting people to be able to do it in Excel is probably, the same line of thinking. But I think those guys were super successful and they were doing the right thing. Do you need to know how to do this math with a pencil and a calculator? Probably not. But actually being able to understand what the inputs are in each spot, it also makes it so that over time you just sort of develop like a more intuitive understanding of when you see numbers, does that NOI make sense based on, certain things? And so the more you can actually just play with those numbers, I think the better that you're going to get at that. Um, so I don't know. This is really what I wanted to show, right? Like, so I think it's a really interesting deal all of a sudden, right? It's a 2018 build. It's in a market that it wasn't. I'm not super excited about it, but it's a decent market. It's one that I don't have any exposure to. Um, I did a little bit of market research in that first video, so you can see that. I didn't go back and watch that whole thing. I probably should have. I think my guess is it's kind of funny to watch because I was very new to Lofty. I wasn't as skeptical as I needed to be, but luckily, just my general real estate knowledge kept me from buying into this one, right? So I'm not out 28% at this point, where a lot of people. No, that's not right, is it? Yeah, it is. I don't know why I keep struggling with that math in my brain, but anyway, I think that these are the kind of deals I think that we're going to start to see more and more of this, right? Like we're seeing, okay, we had an initial property brought to the platform, it didn't perform as it was supposed to. We have some sort of change in business plan. We get a discount along with that. With those two things combined, what does this look like? And I really think a lot of the people that are looking at these deals, most of the math that I saw people discussing around this change was just about the yield, right? Not about, people thinking, oh, well, I can buy into this and get a better deal, right? Even when they're doing that, there's just a lot of people that are looking at the yield and the yield only. And I think looking at that yield, but also seeing like, okay, where we can pick up equity. Because remember, yield is temporary, basis is forever, right? And so yeah, this is not the biggest discount that you can find on the platform, but for relatively new construction in a much better market in my mind than the Memphis or the St. Louis or the Ohio properties. A lot of those properties, if you did real math, would have a similar yield to what this is once they're up and running. And that's if, you know, you probably have to underestimate your vacancy and repairs and maintenance in order to even get there, right? So, comparing this deal to a lot of the deals on the platform, this is one that I could imagine, building a position in over time, especially if the discount stays somewhere around here as a long-term rental with the expectation of holding it long term, right? I mean, I don't necessarily think this is a short-term trade like a lot of the trades that I'm doing. But I think that it kind of is, sort of like how the Garden Gate deal was really good to me. I'm out of that one now. I didn't expect it to be short term, but the price just popped way back up after I bought into it, so I sold out. But it's a property that again, that was a relatively new construction. It was a stable long-term rental. This should become one, right? If it becomes a long-term rental, there's no reason to believe that they wouldn't have wouldn't be a stable market for that. Um, and then, yeah, so it's a combination of, okay, I'm getting a discount and I'm getting appreciation on it. So I'm getting levered appreciation where in general we don't get levered appreciation, right? As he pays down the mortgage, where we're missing out, we get diluted. But until this discount gets diluted away, um, you're getting the appreciation on that full equity amount. I don't know a better way to explain that, but I know that that's not clear what I'm saying. It makes sense in the pictures in my brain. So I don't know. If anyone has questions about that, post that in the comments or jump in the Discord and let's talk about it. But in general, when we get a discount on the equity, that discount acts as leverage. Now it's not a huge amount, right? It's about 10% relative to the equity amount, but it is um, basically that $43 should appreciate even though we're only paying the 39, right? That's all I'm saying. Although then we do get diluted on top of that, but it doesn't seem like this person is in any hurry to pay their loan down, so that dilution's happening relatively slowly. So I don't know. I think it could be interesting from that perspective. One of the risks when I was looking at this is, this NOI does not quite cover the principal and interest payment on the mortgage. Now, obviously, or maybe not obviously, if you're new to Lofty, you don't know this, but the DAO, the entity that we're buying into, isn't paying that principal and interest. It's the co-owner that brought it to the platform. Um, but I always like to see, could we cover it, right? And the answer here is maybe not quite, but it's pretty close, right? Well, let's actually add those two up and see. So 52786 plus 78560. Yeah, so we'd be underwater 55 bucks a month or something, right? And so I, on in the months that we didn't have any vacancy and we didn't have, repairs and maintenance, we would do fine. If we could, maybe even if we could, get a little bit lower management fee or something like that. So there'd be some way to pull it into the entity and not get foreclosed on. But we would be making zero yield at that point, or maybe losing a little bit of money. So I don't love it, but it's not the level of risk where, some of these deals they can't even come close to covering the principal and interest, right? And so, this is why I definitely want to see how this shakes out. What does it actually rent for? Because, if it rents for 2150 or just 2200, that's a big enough difference to care. And if it rents for 2300, that'll make a difference as well, right? So what, but also really just seeing how that process goes, how quickly they get a tenant in there will will really give us a lot of info about what that, how much we need to worry about vacancy in that market. Is this a market where we're going to have people lined up to pay that amount and maybe we can push rents over time? Or is it a market where we're just going to barely get someone in there and we're going to wait 2 months every time? If that's the case, then yeah, this is not a deal. I'd want a much bigger discount. One thing to keep in mind is no matter how big that discount is, it doesn't change whether or not the Dow can cover the mortgage, right? Now, it might change our willingness to do a capital call to pay the mortgage down or do something else, create an interest reserve. until rents catch up. All of those things I think are possible because we're not talking about being hugely off, but it's far enough off that I'm gonna care about it. If our expenses grew faster than rents, it could cause a problem. So, I don't think this is a perfect deal. Um, by any means, but I think it's a lot more interesting than one. Well, it's a lot more interesting than it was when it first came to the platform, right? And I know people are thinking like, well, wait a minute, when it came to the platform, it was 19% yield. No, it wasn't. I mean, that's just the facts, right? Like it is, I'm not a fortune teller, but I was able to, at that point in time, understand that that was not going to be a yield, that would hold up. And at least not, I, I couldn't be confident enough in it holding up that I'm going to bet on that deal, right? Where here, once you have a long-term tenant in it, I would put some money on this being somewhere around a 7% cash on cash return, provided it actually gets rented at the 2250. If it gets rented higher, maybe even higher, right? And so, uh, yeah, that's what keeps me on Lofty, right? These discounted tokens, the discount to the true property value. This is one of the things that like you don't get on some of the other platforms as well, too, right? Like so, some of the platforms, if it's a short-term rental and it's not performing, we don't get to vote on changing it to a long-term rental or doing something else. I think that's a benefit. It's also a detriment, right? Like it's a risk. I mean, some of the votes that we've seen in some of the DAOs have just been absolutely stupid. People have really run properties into the ground. But I think that if you get some other good owners in your DAO with you, and you come at them with facts and a good plan, for the most part, it hasn't been too difficult to get people to move along with business plans that I think make sense. And then on the flip side of that is my guess isn't always going to be the right one, right? Like what I think we should do with the property. Some of the proposals I've made for selling Odom, the market just wasn't there for it for where I thought it was going to be after talking to some agents. So, but again, we have the ability to pivot and do something else. And so this is, I think, a good example, right? But I think for the most part, on Lofty, so far there have been hardly any deals that, when they come to the market, to me, make sense to buy right then. But once you get a discount and maybe now have a little bit of a change, right? Whether it's a change in property managers, whether it's a change in strategy, I don't think that necessarily has to be the case, right? I mean, sometimes it's just it's moving along, spitting out a lower yield than people expected, but then that creates a big enough discount to be interested in it. Anyway, that's about all I have to say about that. Please do check out the earlier video if you hadn't already seen it. I do go into talk about the market a little bit. I think it is kind of funny how I did watch a couple minutes of it, and I definitely trusted Lofty a little too much back then, although was already pretty skeptical about a lot of things. So yeah, check that out. There'll be a link in the description to this video for that. And I'm going to try to put it on one of these end cards too. So if you see it, it'll be like investing in short-term rentals online or something. I don't know, but you'll see it if I can get it on one of the cards. But if not, you'll definitely see it as a link in the description of this video.